Welcome back to Trader UK, the money management channel. Today I have a video for the investors among you. I'm going to be running through dividend tax, how it works and when you should be paying it. I think that a lot of investors out there aren't actually aware of how the dividend tax really works. Maybe they just assume that the withholding tax you see in your trading account when you receive your dividends from Coca-Cola is the dividend tax and it's being applied automatically, when in fact this is something completely different. Or maybe they think they just don't need to pay dividend tax at all. And in a lot of cases, they actually end up being right. But that's because of the size of their portfolio and the amount of dividends they're receiving. Now, as the portfolio grows and the dividends start rolling in, you can actually end up getting caught out for avoiding tax. So if you can take the time to watch this video and get yourself a basic understanding of how the dividend tax works and is applied, then you can make sure that you're never caught out like this. So what I'll actually cover in this video is how dividend tax is applied, who might need to pay it, and of course the different rates that you might pay. And then just to show you how dividend tax can be a pretty complex area, I've done a few calculations that demonstrate how your tax liability can vary depending on your level of income, but also where your dividends are being sourced from. And once you know this, you can design your portfolio around that information, because trust me, you'll see once that dividend tax really kicks in, it makes dividend investing a whole lot less attractive. Before we do get going today, don't forget to subscribe for more similar content. And of course, if you enjoyed today's video and you take some value from it, don't forget to smash the like button, as that will really help me out with the channel. Now, if you ever want to get a good understanding of dividend tax or any UK tax for that matter, you should be heading across to the gov.uk website. Everything that you need to know is going to be detailed on this website. Occasionally, if you don't have a background in tax, and the wording can be a little bit confusing, so I'm going to switch across to my laptop and I'm going to run through what it says with you now. Now, I'm going to read through everything for you on screen in one go, and then we'll come back and run through the main highlights. So, how dividends are taxed. You may get a dividend payment if you own shares in a company. You can earn some dividend income each year without paying tax. You do not pay tax on any dividend income that falls within your personal allowance, which is the amount of income you can earn each year without paying tax. You also get a dividend allowance each year. You only pay tax on any dividend income above the dividend allowance. It also says here, you do not pay tax on dividends from shares in an ISA. And then below, you can see a table which highlights the dividend allowance that it mentioned before. We only really need to pay attention to the top line, the current tax year, April 2020 to April 21, which is £2,000. It used to be more than this when it was first introduced. It was £5,000 originally, but it's been reduced down to £2,000 per tax year. Now, the first line here, you may get a dividend payment if you own shares in a company. That's actually quite important. I don't know if people are aware of this, but dividends can only be paid from profits. So if you're investing in a loss-making company such as Upwork or Fiverr or Beyond Meat, those companies cannot pay you a dividend. Even if they have a couple $100 million sat on the balance sheet, which many of them do as they do different rounds of capital raising, they cannot actually distribute that money to its shareholders because they haven't made any profits yet. And then it goes on to say here, you do not pay tax on any dividend income that falls within your personal allowance. You can see here on the HMRC gov.uk website, the personal allowance is currently £12,500 per tax year. It can vary a little bit, but for the majority of people, that's going to be your personal allowance. And that means that if you don't have any other sources of income, if investing is your only source of income, then you can actually receive $12,500 worth of dividends straight away without paying any tax. After that, it tells us that on top of our personal allowance, you also get a dividend allowance each year. You only pay tax on any dividend income above the dividend allowance, and then goes on to tell us that £2,000 is the current dividend allowance. So once you've combined that with your personal allowance, if you have no other sources of income, then you can actually receive $14,500 in dividends straight away without paying any tax. And then it has a quick one-liner to say you do not pay tax on dividends from shares held in an ISA. I'm actually going to post a separate video about ISAs, when you should be using them, when it's not really effective, and who they work best for. But just know that at the moment, the ISA allowance is £20,000. And then it shows you how much tax you'll actually pay once you've utilised both of those allowances. So first of all, you've got your £2,000 dividend allowance. Then you've got your personal allowance of $12,500, and then the basic rate kicks in for dividends. That's 7.5%. So anything from $12,500 up to £50,000 in a tax year is taxed at 7.5%. After that, it's higher rate at 32.5%. The higher rate band runs from 50,000 right the way through to 150,000. And then finally, additional rate at 38.1%. Additional rate, anything above 150,000. And when you're calculating which tax band you belong to, you need to take into account all of your other sources of income. So if you have rental properties and employment income and pension income that totals over 150,000 per tax year, then you know that your dividends are going to get taxed at the additional rate, which is 38.1%. And if we switch across to my examples, I'm going to run through these on screen for you. First up, example 1, somebody with no other sources of income, no salary. They have a personal allowance of $12,500, but it's not being utilised against their salary, so it can be carried forward and used against dividend income. You also have your dividend allowance, which we mentioned, of $2,000, which means that you can have dividend income up to $14,500, and you won't pay any dividend tax on that in the UK. Now, that is a pretty considerable amount, £14,500, but you should consider where this income is coming from. If it's from UK-based companies that have paid you that dividend, then yes, there'll be no further tax to pay, and you haven't incurred tax on those dividends at any point. If, though, your dividends were received from foreign companies, maybe they're from US companies that have paid you dividends, remember, $14,500, that's the gross amount. You haven't actually received the gross amount, you've received the net amount. They've already deducted 15% and then they've paid it across to you. Which actually means once you've received your £12,325 worth of US dividends, that's going to be your $14,500 allowance utilised. And then the $2,175 that was already deducted as a withholding tax in your trading account, unfortunately, that is lost. So although you're not paying a dividend tax to the UK, you've already lost $2,175 in withholding tax. Then you can see example number 2, we're adding in a salary here. So you have other income. 25,000 salary utilises your personal allowance of 12,500 and means that you have none to use against your dividend income. You still have your dividend allowance of 2,000 that never gets taken away, irrelevant of what level of income you might have. Now let's assume you then receive 5,000 of dividend income on top of this, minus the dividend allowance of 2,000, leaves you with £3,000 of taxable dividends. £3,000 would be taxed at 7.5% because with 25,000 of employment income or salary, you're falling into the basic rate category, and your dividends would be taxed at 7.5%. That's a tax bill of £225 payable to HMRC. Now, assuming that these dividends again were received from UK-based companies, then that would be the end of it. You'd pay your £225 to HMRC and it's done with. Now, in example 2, if these were actually US-based dividends again, Again, you need to gross them up first of all. So actually here, you didn't receive 5,000 of dividend income. You received 5,882 once you take into account the 15% that was withheld at source. You can still deduct your 2,000 dividend allowance from that, which will leave you with 3,882, taxable at 7.5%. which is a tax bill of £291.15. The 882 of withholding tax can be offset against this bill because the UK and the US have a double taxation agreement, which will reduce it down to 0. But unfortunately, the difference between 882 and 291 cannot be recovered. And in our third example, highlighted in green, you can see we've increased the salary to 50,000. That puts you automatically into the higher rate tax band, meaning your dividends are taxed at 32.5%. The personal allowance is already utilised, no personal allowance to carry forward. You still get your 2,000 dividend allowance. So assuming that you had 5,000 of dividend income, in this case from UK-based companies, that leaves you with 3,000 taxed at 32.5%. HMRC would want £975 from you. If, however, these were US-based dividends again, you would need to gross them up, so it's 5,882 again. You still take off your 2,000 dividend allowance, leaves you with 3,882. Taxed at 32.5% is a tax bill of £1,261.65. Of course, you've already had 15% withhold by the US, which is £882, and that's going to leave you with a further liability that needs to be paid to HMRC of £379 there or thereabout. So you can see here, it gets a little bit complicated with different levels of income, different sources of income, and dependent on where the dividends are actually coming from. So it is very important that if you are a UK-based investor, that you take this into account when you're building up your portfolio. I often see advocates of dividend investing who only hold dividend stocks. 100% of their portfolio is held in dividend stocks. And I often see it the other way, advocates of growth stocks who hold 100% of their portfolio as growth stocks. The truth is, every portfolio should really be balanced, but certainly from a tax standpoint, there is no set percentage of each that you should have. It's going to vary for everyone depending on where that income's coming from and other sources of income. But in my opinion, everybody should be considering tax when designing and building their portfolios, because if the tax man does start taking more than a third of your income, you're probably going to be regretting the way you set up your portfolio. That's it for today. As always, guys, thank you very much for watching, and I'll see you next time.